The market is closed for the weekend, and GSI Technology, ticker GSIT, is frozen in place after an absolutely brutal trading session on Friday, October 31st. The stock closed the session at $9.09. That was a catastrophic drop of $1.97, vaporizing 17.81% of the company's value in a single day. And the pain didn't stop at the bell. In the after-hours market, it slipped further, down another 6 cents to $9.03. This $9 level is critical, and seeing it break down this violently has left a lot of investors, especially those who piled in over the last month, asking what on earth just happened. Many are pointing to the company's fiscal second quarter 2026 earnings report, which was released on Thursday, October 30th. And that's certainly part of the story. But if you think this 18% collapse was just about the earnings numbers, you're missing the real story. What we just witnessed wasn't just a reaction to a quarterly report. It was the violent collision of a high-flying narrative with the harsh reality of corporate finance. The expectation for GSIT has been that its new AI-focused chip, the Gemini Associative Processing Unit, or APU, is going to be a titan in the industry. The hype was palpable. Just back on October 20th, the company blasted out news of a Cornell University study validating the APU. The headlines were incredible. The Gemini I chip was apparently delivering performance comparable to an NVIDIA A6000 GPU, but, and this is the key part, using 98% less energy. In an AI world starving for power and efficiency, that claim is about as strong as it gets. It's the kind of story that gets investors dreaming of a 10x return, the kind of story that took this stock from a 52-week low of $1.62 all the way up to a high of $18.15. That was the expectation. Then, on Thursday, reality hit. The fiscal Q2 earnings report came out, and the numbers weren't a disaster, but they showed the strain. Revenue came in at $6.4 million. The company reported a net loss of $3.2 million, or 0.11 per share. Now, that's actually an improvement from the $5.5 million loss they posted in the same quarter last year. But here's the detail that mattered. The loss was wider than the $2.2 million loss from the previous quarter. Operating expenses were up. Research and development costs climbed to $3.8 million from $3.1 million in the prior quarter, and selling, general, and administrative expenses also ticked up. This is the classic sign of a company in a high-stakes development phase. The cash burn is accelerating. The AI dream is expensive, and that $6.4 million in revenue isn't coming from the magic Gemini chip. It's coming from their legacy business selling high-performance static random access memory, or SRAM chips, to the military, defense, and telecommunications sectors. That's a solid, respectable business. But it's not the AI powerhouse that the market was pricing in. So the earnings showed an accelerating cash burn. But the real knockout punch, the catalyst that truly set the stage for Friday's 18% collapse, had actually been thrown 10 days earlier. On October 21st, GSI Technology announced a $50 million registered direct offering. This is where the story gets painful for existing shareholders. The company sold 1.5 million shares at $10 apiece and pre-funded warrants to purchase another 3.5 million shares at $9.99. Think about that. The company just printed millions of new shares. For a stock with a relatively small public float of around 26 million shares, this is a massive dilution event. It was a necessary evil. The company's balance sheet at the end of September showed $25.3 million in cash. That's not enough to fund an all-out war against the giants of the semiconductor world. That $50 million offering was a lifeline. It was the fuel required to keep the Gemini APU project alive and bridge the gap to commercialization. But it came at a steep price for investors who had just bought in at $12, $15, or even $18. Friday's drop was the market finally putting all the pieces together. The excitement from the Cornell study was completely overshadowed by the 1-2 punch of accelerating cash burn from the earnings and massive shareholder dilution from the $50 million offering. The stock, which had been fighting to stay above $11, just fell through the floor. The $10 offering price acted as a giant magnet, pulling the market price down toward it. With millions of new shares now in the hands of institutional investors who bought at $10, there was almost no support above that level. Anyone who bought higher was instantly underwater and running for the exits. The stock didn't just fall, it gapped down and never looked back, closing right near its low of the day, $8.96. This brings us to the activity that many retail investors are probably screaming about right now: short sellers. When a stock collapses this hard, the first cry is manipulation or short attack. So let's look at the actual data. What's your take on the high daily short volume? Is it just arbitrage around the $10 offering or something more? When we check the official reported short interest data, the number of shares held short by fundamental bears, it's actually incredibly low. The most recent data from mid-October shows a short interest of only about 211,000 shares. As a percentage of the float, that's less than 1%. The days-to-cover ratio is negligible at less than 1. This means, unequivocally, that GSIT is not a short squeeze candidate. There is no massive coordinated army of short sellers betting against the company's long-term future. The borrow fee rate, the cost to borrow shares to short, is also very low, at around 1.18%, confirming there is no significant demand to short the stock. So why does it feel like a short attack? This is a crucial distinction for investors to understand. While the overall short interest is low, the intraday short volume ratio has been very high. On recent days, the FINRA off-exchange short volume ratio has been spiking, hitting 58% and even 61% on heavy volume days. This is not the same as fundamental shorting. This is high-frequency trading, market makers, and arbitrage funds at work. What were they doing? Most likely, they were trading around the $10 offering. An institution buys millions of shares in the offering at $10. If the stock trades in the open market at $10.50, they can short the stock at $10.50 and lock in a risk-free 50-cent profit, knowing they have the $10 shares from the offering to cover their position. This activity adds massive selling pressure and volume, but it's mechanical, not fundamental. As an investor, it's critical to know where to find this data. Don't just look at a daily short volume chart from FINRA and assume it's a short attack. Go to the official NASDAQ site and look up the bi-monthly short interest report. That tells you the real story. In this case, the data shows the drop was caused by dilution and fundamental selling, not a short squeeze narrative. So, where does GSI Technology go from here? The company's identity is split in two. You have the legacy GSI, a stable, if slow-growing, provider of specialized SRAM memory for critical systems. This part of the business provides the $6.4 million in quarterly revenue and keeps the lights on. Then you have the future GSI, the AI company building the Gemini APU. This is the R&D-heavy, cash-burn-intensive part of the company that holds all the promise. The Gemini chip is a compute-in-memory design, which means it performs calculations directly inside the memory, avoiding the bottleneck of moving data back and forth between a processor and a separate memory chip. This is what enables the massive energy savings. The Cornell study focused on retrieval-augmented generation workloads, a key component of advanced AI, which suggests that the technology has a very specific, high-demand application. The company has already announced the Gemini 2, which it says is 10 times faster than the chip in the study. The bull case is simple. The $50 million in new cash gives them the runway to get Gemini 2 into the hands of a major data center, cloud provider, or edge computing company. If they can land one significant design win, one partnership that validates the 98% energy saving claim at scale, this stock will not stay at $9 for long. The AI market is desperate for efficiency, and GSIT's technology is, on paper, a brilliant solution. The risk, however, is equally stark. This is a tiny company trying to compete in a field dominated by NVIDIA, AMD, and Intel. They are burning through millions of dollars every quarter. That $50 million will not last forever. If they fail to get commercial traction before the cash runs out, they will be forced to dilute shareholders again, and the price will spiral lower. We've also seen some insider selling over the past few months, which, while not massive, is never a sign of confidence heading into a major product launch. This is the ultimate expectation versus reality stock. Friday's 18% crash was reality reasserting itself with a vengeance. The market is now saying, the AI story is great, but show us the revenue, show us the adoption. The $10 offering price is the new ceiling. The $8.96 low from Friday is the new floor. The battle for the next 6 months will be fought between these levels. Given the massive potential of the APU but the immediate reality of the cash burn, are you holding GSIT for the long term, or did Friday's drop shake you out? Comment below. The narrative has been reset. The hype has been flushed. Now, GSI Technology has to execute.